So fantastic to have you with us today, Arjun. Okay, so let me start off with my questions. So what's the best financial advice that you can share that you practice personally?
Okay, great question to begin with. So I had the good fortune to work with a lot of wealthy individuals across the globe for over a decade now, right? And I've researched a lot of wealthy individuals and investment managers like Warren Buffett, Howard Marks, Ray Dalio. And there's one mindset, one strategy which differentiates them from all the others. I've seen across the board. And this mindset is called the wealth mindset.
Okay.
Right? I will try to illustrate with an example what I mean. What is the meaning of having a wealth mindset?
Sure.
Is the screen visible?
Yes, it is.
Okay, great. Can you identify the two gentlemen on the pictures, the two pictures there?
Oh, who wouldn't? Jeff Bezos and Vijay Mallya.
Great. Now, there's a reason I put in the picture. Suppose you didn't know these gentlemen, right? And you saw the gentleman on the left step out of his car and the gentleman on the right step out of his car.
Yeah.
As an individual, what would be your first perception? Who is more wealthier of the two, or who is more richer?
Definitely, I would assume Vijay Mallya is, seeing that he's driving a fancier car than Jeff Bezos.
Right. But the fact of the matter, reality on ground is, Jeff Bezos is the richest man on the planet. I do not want to comment on Vijay Mallya, right? So the point I'm trying to make is, there are some key success markers for people who have the wealth mindset, right? So what is this wealth mindset? So the first thing is, wealthy people try to own assets versus having liabilities or loans in layman terms, right? That is the first marker. Second, wealthy people, the wealth, you cannot see it, right? So either they own a business, they own financial assets like mutual funds, equity shares, and even real estate properties, which they own. Now, suppose I'm wealthy, I cannot put a board saying that, okay, I own 3 crore in mutual funds, 1 crore in equity shares, and another 2 crores in real estate properties, right? True. I cannot put a board around my neck.
Yeah.
Versus the rich, if you look at them, their possessions, I'll use the word possessions, not assets, because assets is what puts money into your pockets. Their possessions can be seen. So they have fancy cars, like this gentleman on the right. They'll have fancy houses. They'll have fancy mobile phones, right? But majority of them do not own these assets. They have taken them on loans.
Right. That's true.
So humbly, I would like to submit that it is disguised poverty. So they appear rich, but is actually disguised poverty, right? The number 3 differentiator between the wealth mindset and the rich mindset is, wealthy people try to earn passive income, which by definition means that they do not have to work for it. Over a period of time, it is actually coming in even while they're sleeping.
Understood. Okay.
Versus rich people have earned income. So they have to work for someone to get that income. They have to put in the time. So those are the 3 key differentiations between a wealth mindset and a rich mindset. And majority of the people, you would agree with me, try to live the rich lifestyle versus having the wealthy lifestyle.
I think you're right. I think almost like 80% people would pretty much be doing the same thing right now. I possibly can't think of even a single person that I know of who's living a loan-free or an EMI-free lifestyle. So, Arjun, what investment strategy do you think can help you get really rich. Well, not rich, actually, wealthy, you know. So I think I should stop using the word rich now.
Right. So there is a strategy, and I'll pull that slide up soon, but one thing I wanted to say that a lot of your audience must be thinking after the first question that, okay, so we don't own a business, we are salaried, can we become wealthy? And the answer to that is absolutely yes.
Okay.
And the answer is through investments. You do not have to have your own business, but you can own somebody else's business through investments, which the market gives you an opportunity. So let me explain that concept and answer your second question.
Sure.
Do you recognize the lady on this slide?
I'm afraid not. No, I don't.
Okay. This lady's name is Grace Grona. She was born in 1909. She got her first job right after the Depression with a big pharma company as a secretary. And she bought her first investment or the shares in her company which she was working in. So she bought 3 shares of $60 each. So in sum, $180 of shares, and she never sold those shares for the next 75 years.
Got that.
So she just kept on reinvesting them, right? And so Grace worked in that company for 43 years. She didn't go on to become the CEO of the company. She was in the secretarial staff. She lived in a lower to middle income family housing in a small county in Chicago, right? In 2008, she decided that she would transfer all her assets in a foundation which would be finally given to her college, which is the Lake Forest College in which she studied.
Okay.
Grace passed away in 2010 and her assets were liquidated, which were the shares she had bought. And the proceeds were given to her college. Do you want to venture a guess, Sheetal, how much was the amount that was given to her college? If you were to venture a guess.
So the original amount was about $180, you said, right?
Yes.
Okay. I think about 80,000 to $1 million, perhaps. I'm considering.
Sorry, what was that?
80,000 to $1 million, considering as much time has passed.
Okay. So the actual amount came to $7 million.
7 million? Like, really?
Yes, and that was the exact reaction of the endowment officer for the college when he heard it.
Okay.
Right? So that's the story on building wealth. But let's now get into the details, right? How does a person get wealthy, right?
Sure.
So I'm sure that 99% of your audience has seen this formula on your slide in high school. And I can say with conviction that 99% of them have already forgotten about this formula, which has the hidden secret of building wealth.
Okay.
So I will give 5 seconds for your audience to just recollect and go through this formula. Okay. Now, A is the amount that you finally make through a principal that you had invested. R is the rate of return, and T is the time for which you were invested. Okay. Now, most of the investors or your audience, I can venture a bet that they focus on the R, rate of return.
Yeah, I think that's pretty much the first question that anybody asks.
Right. How much would I get?
Yeah.
Right.
Very true.
But they tend to ignore a more important. I'm using the word more important. I'm not saying that R is not important. I'm saying they forget or ignore the more important concept, which is T. If you look at this formula, T is the exponential component. R is the linear component. Right? So they tend to ignore this. So I'm sure it's difficult to visualize how does this work. So I'll show you a slide of what is the implication of this thing T. which by the way is in your control, right? T is the time for which you remain invested in.
Okay.
That's totally in the control of the investor.
Okay.
R is not in your control. It is dependent. It's dependent on your expertise in investments, or if you've given it to your investment to an advisor, their expertise of growing the rate of return. It depends on market situations. So it's out of your control.
P, I suppose, is the principal
P is also in your
have.
control.
Yeah.
How much amount you invest in.
That's the original
right?
invested amount.
T is in your control, and it is the most important factor.
Understood.
R is in your control in terms of if you are the expert, or if you are very good in selecting the advisor who's an expert in giving you a good R.
Got that. Okay.
Right? So let me show the impact. So if you had invested 10 lakhs over a period of 40 years with a constant annualized rate of return of 12%, which is not constant actually, it goes up and down, but over a period of 40 years, if you work out the math, if it is 12%, this is the graph that you'll see. So if you had invested 10 lakhs, it will become close to 10 crores in 40 years.
Wow.
But if you look at the slide carefully, what do you see? What is the insight that jumps out at you?
What I can see is that the longer that you stay invested, the higher are the returns. And of course, the curve gets a lot more steeper as time progresses.
Right. Towards the later half of the tenure, right? Yeah. The later half.
The initial part of it looks a little flatter, relatively.
Flatter because the amount is lower, right? So the it's compounding. And after a certain time, there's a point where it just takes off. Right? So that is important, very important. So, but what is causing this thing? That the factor T, time, which is under whose control? Your control.
Yeah, true.
Right? So whatever I've said up till now is in your control. The mindset is in your control.
Totally.
The time is in your control.
Yeah, I think time is something that we all keep forgetting. You were so right when you said initially that, the first thing that we probably ask even our financial advisors is, oh, how much am I going to get in return for the amount that I'm investing? Yeah,
right.
That's true.
And one more question that must be coming in your audience is, do I have to wait for 40 years to make so much money? Right?
Yes.
So to answer that question, there are two ways of solving that problem, right? So one is, if you already have enough money, right? So if you've already at the 4 crore mark or 2 crore mark, then you do not have to wait for that long. Either you increase the principal, right? Or you increase the time. And the second part is, even if you don't have the principal, just because you've not followed the right principle for the last 20 years doesn't mean you do not follow it for the next 20 years. Saying that 40 saal to aur bache hi nahi. We do not have 40 years, right? For us.
Yeah. So basically what I can see from here is, no matter at what stage you start off, yes, maybe if you're investing for 20 years, maybe your returns would not be as high as what it would be for 40 years, but saying that it's still an increase in what you would have otherwise got, perhaps. If you would have.
And now another important component is rate of return, which is important, not as important as T. But what is this rate of return? If you see in this figure, we've kept the rate of return fixed at 12%. Correct. Right? So let me demonstrate what. So what really counts is the real rate of return. So when investors ask rate of return, they think, okay, whatever I'm getting, like if I say 10%, okay, 10%, great, right? But what really matters is real rate of return. And I'll explain this through this picture, if you can see it on your slide.
Yes.
Inflation, I hope everybody understands what that is, right? So in India, the inflation on average for the last 40 years has been 7%, which our research will go down to 6%, but it will stay at 6%. But to explain the concept, let's assume that the inflation for the next 20 years is 5%, right?
Okay.
You invest your money in fixed deposits and you get 6%, right? So you think that you made 6%, but in the real return concept, you've actually made 1% because inflation is 5%. 6%, 6 minus 5 is 1%. Similarly for gold, you may make 7%, but actually the real return is 7 minus 5 is 2%, so on and so forth, till you get to the stock market, which is equity mutual funds also. It is around 12%, the average, long-term average.
Understood. Okay.
which is, but it is 7% over, so real return.
Got that. Yeah.
And thereafter, you also have to consider the taxes.
Sure.
So after tax real rate of return,
Mm-hmm.
right? That is what you actually make. So I can come and tell you, oh, we will invest your money and you are going to get 14%. Your next question should be, what is the real rate of return that I'm getting? Because that is what is compounding,
Correct.
right? So
Correct.
to use the last example, what I mean is, if I invest my money, say 10 lakhs today or 50 lakhs today in fixed deposits, because it is safe, and it gives 6%, it will double in 12 years. How did I come up with this figure of 12 years? You remember the rule of 72. So divide 72 by the rate of return that you're getting on any investment class. That is the amount of time it will take to double your money. So in this case, if the return is 6%,
okay. So it's
divide 72 by 6, you'll get 12 years to double your money. But if you look at stocks, equity, mutual funds, it is 12%.
Understood.
So to double your money,
it will take half the time.
It'll take half the time.
Yeah. Okay, that's a very interesting insight, Arjun. I think this.
Right. So real rate of return, just to quickly summarize, look at the real rate of return. Look at the even more important concept, which is time. And that helps the formula of compounding, which you'll hear ad nauseum. But how does it work in reality is what I've just told you.
Okay, so moving on, a lot of people have lost their jobs because of COVID, and they have obviously got their recurring expenses as well. So what would your advice be for them? If a push comes to shove, should they really consider taking a loan, or should they be surrendering their assets or investments? And if yes, then what investments should they typically look at surrendering? I think some insights around those would be definitely helpful.
So absolutely. So I will start off by saying what the mistakes people make. The mistake investors do is follow the herd, which is like 99% of people like them. What they typically do is, what happens in a market crash? What happened in COVID? From January to March, the markets fell by almost 40%. Actually, to be precise, 39%.
Okay.
So what did most investors at least think of doing? Okay, let me sell off the equity quickly, right? Because it's falling rapidly. So let me sell the equity part quickly. Now, equity, very by nature, all your advisors, whatever you read on news and everything, is that it is a long-term asset.
True.
And I just demonstrated the time factor, right?
Absolutely.
So you have sold assets which are supposed to be kept for the long term at the worst possible time when they've lost half their value, and you've recorded the loss by selling it off. So what my suggestion would be, try to redeem the low short-term investments. So which is FDs for 1 or 2 years. It sounds counterintuitive, but that's what you should do for the reason I told you. Or fixed income debt mutual funds for 2-3 years, because they would not have fallen that much even in a market crash, because they're fixed income kind.
Correct.
And they are for the short term anyways. So you dispose them. Now the other point about taking loans in these times, in a market crash kind of a situation, it's very difficult to get loans, and even more so if you lost a job or you're verge of losing job. And even for people who get the loan, the interest rate would be much higher.
Very, very high. That's true. Yeah.
Right? So it doesn't make sense. You will not get a good deal. So you'll not make a good investment. It wouldn't be a wise financial decision, so to speak.
Yeah,
so
and I think
dispose of the or redeem the short term.
Yeah, and in so many ways, I think people get into a panic mode. And I was just kind of retrospectively thinking of the example that you took just a little while back about grace. Great. I think, that makes sense.